If you've seen the headlines, then you've heard that Michael Burry is betting over $1 billion that the AI bubble is about to pop. This is the guy who correctly predicted the global financial crisis in 2008. Now he is shorting Nvidia and Palantir, two of the most hyped companies in the tech sector. In this video, I'm looking at what Michael Burry is actually doing, if his analysis holds up, and what that means for value investors like ourselves, because if he's right and we're not prepared, we could be holding the bag on a ticking time bomb. So first, let's start by looking at the actual evidence. Everything that the media is talking about is right here. This is Michael Burry's 13F filing. He is required to make this filing 4 times every year for his hedge fund, and all it shows is a snapshot in time. On September 30th, this is Michael Burry's portfolio. We can see that he has put options on Palantir and Nvidia, and a put option at its most basic level just means if the stock price goes down, Michael Burry makes money. And so when people see this filing and then they see number of shares held, 5 million of Palantir, 1 million for Nvidia, with a market value of combined $1.1 billion, the headline says Michael Burry is shorting $1.1 billion. That's his bet. He's betting $1.1 billion that the AI bubble is going to pop. But the problem is that we don't know exactly how much Michael Burry actually put into this trade, because this is just the number of shares that his put options control. He doesn't hold the shares. He has put options on 5 million shares of Palantir, and he has put options on 1 million shares of Nvidia. When you buy one put option on Palantir, it gives you the right to sell 100 shares of Palantir per put option at an agreed upon price within an agreed upon amount of time. Now, in this case, we don't know what the agreed upon price is for Michael Burry. We don't know the length of these put options. All we know is that on September 30th, he had these options in place. As far as the premium that he paid for these options, that is the actual size of his bet. It could be anywhere from 1% of the total share value to 50% of the total share value. It could be a huge range. It could be as low as $10 million, or it could be as high as $500 million. So we don't know the size of his bet. We don't know the nature of his bet. All we know is that on September 30th, Michael Burry thought that these shares would drop in value. By this time, the time that I'm recording this video, this is November 9th, he could have already sold these put options and he could be on to something else. He could be long on Palantir and Nvidia right now as we speak. There's no way to know.
What's up, y'all? It's me from the future. Not really. It is November 13th. I filmed this video on November 9th. A lot of new information is dropped that I had to include on this video. So 2 days after I recorded this video, a letter from Michael Burry to his investors leaked. He is shutting down Scion Asset Management. He's shutting down his hedge fund. So a lot of people are jumping to conclusions saying, oh my God, he must have lost tons of money on his put options. And so I want to get into the latest information just really quick. I wanted to just splice this into the video. So his letter says, dear investors, with a heavy heart, I will liquidate the funds and return capital, but for a small audit / tax holdback by year's end. My estimation of value in securities is not now, and has not been for some time, in sync with the markets. So he's saying the markets are basically way too overinflated. Everything seems out of sync to him. So he is shutting down the hedge fund, and he does not expand further. He goes on to say that his investors should contact this other guy, PM Phil Clifton. His poor guy got his email leaked and his phone number leaked. So who knows how many people called him, but Michael Burry adds, Phil is a tremendous young talent in the field of investment and the most prodigious thinker I have ever encountered. So lots of speculation that he's lost a bunch of money on his puts. He has also since tweeted the specifics on his Palantir puts, but not his Nvidia puts. So on X, he said, I bought 50,000 of these things for $1.84. So he spent $9.2 million on the Palantir puts. If we assume a similar proportion, he spent $1 or $2 million on the Nvidia puts, and that would put his premium that he paid in line with my lower projection, which is around, probably he spent 10 million, 11 million perhaps. So he did also include more information about the specifics of the puts. So he said they expire in 2027, didn't say when, and they are at a strike price of $50. So I looked up what they're trading for right now. For January 2027, they're anywhere from $2 to $2.50. and then it only gets more expensive as you go later out or further out in time. So he probably didn't lose much money, if anything. He could be up 10, 20, 30% on these. So interestingly, he is shutting down his hedge fund, and I have not seen any explanation at all yet, but a little bit more color on the nature of the put options, a year to a year and a half out, we'll say, depending on when in 2027 that he is purchasing these. So relatively long dated put options expiring at $50 per share. Now, he doesn't need Palantir to drop to $50 per share to make money. It just needs to start dropping towards that soon, and then the value of his put options will go up as the probability of hitting $50 increases. So got a little bit more to add, but I'll back to the video.
But let's dive a little bit deeper on what we could speculate Michael Burry is thinking with these put options. The first thing to note is that Palantir had their earnings report on November 3rd. So it could be that Michael Burry bought these put options because he thought Palantir would underperform on their earnings report. If we look at the past month, Palantir is down slightly. So in this case, Michael Burry probably hasn't made very much money on this put option at this time, if that is indeed what his strategy was. As for Nvidia, they have their earnings report on November 19th. Over the past month, Nvidia is also pretty flat. So at this time, Michael Burry is probably losing some money on those put options if he still has them. He may be holding these put options until Nvidia reports on their quarterly earnings, but we have no way of knowing that because Michael Burry has not commented on the nature of his put options. And the reason I'm saying he probably doesn't have more than $500 million in these put option premiums is because his hedge fund's net worth is estimated to be around $500 to $600 million. The other angle we can look at to get in Michael Burry's head and see why he is shorting these two companies is we can look at his investing strategy for whenever he's going long on a company. What does he like to see if he's going to make a positive bet? And if he's shorting the company, then it's very likely that the company is exhibiting the opposite of what he is looking for. So right here, this is a one-page explanation by Michael Burry about his investing strategy. He says, my strategy isn't very complex. I try to buy shares of unpopular companies when it looks like roadkill. In other words, they are incredibly low in value, and then he sells them when they've been polished up a bit. Right off the bat, Nvidia and Palantir, these are darlings of the stock market. They are far from roadkill. They are incredibly popular as well. So this is already the inverse of his first few sentences here. My weapon of choice as a stock picker is research. It's critical for me to understand a company's value before laying down a dime. I really had no choice in this matter, for when I first happened upon the writings of Benjamin Graham, I felt as if I was born to play the role of a value investor. So how does Michael Burry determine if a stock is indeed overvalued or undervalued? He says that right here. How do I determine the discount? I usually focus on free cash flow and the enterprise value. Free cash flow, that is a classic value investing approach. Enterprise value, this is the market capitalization minus their cash plus their debt. He will screen through large numbers of companies looking at the enterprise value divided by EBITDA. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. So first, let's start with Palantir. So if I go to Palantir's ratios page on stockanalysis.com, we can see that their price divided by their free cash flow is 236. You want to see that number being very small. So the free cash flow, if that number is big and their price is small, then the ratio will be small. This is a large ratio. Their EV divided by EBITDA ratio is 477. This is also a large ratio. And just to give a counterexample, we can look at Michael Burry's current portfolio. Let's go back to it. So he has call options on Pfizer and Halliburton. So these are two companies that he thinks is going to go up. As an example, let's look at their ratios so we can get an idea of what he's looking for. So for Pfizer, their price to free cash flow ratio is 13 compared to Palantir's 277, and their EV to EBITDA is 7.6 compared to Palantir's 477. So These values are way out of whack. So this is the initial screen potentially that Michael Burry is looking at where he's like, wow, Palantir looks crazy. Now let's see what their free cash flow valuation implies. This is my automated spreadsheet where I estimate the intrinsic value of companies by projecting their future free cash flows. I do this by taking the analyst projections for future revenues, and then I multiply that by their historical free cash flow margin. That's the percentage of their revenue that a company is able to generate free cash flow. Using these assumptions, I can calculate a projected intrinsic value based on my desired stock returns and their future free cash flows. So in Palantir's case, historically, they have had an average free cash flow margin of 15%. I am boosting it up to 20 because that is their most recent free cash flow margin. We can see here that their free cash flow margin has been increasing over time. I am also using the analyst projections for their future revenue. I got that from stockanalysis.com right here. So the analysts are projecting lots of revenue growth. Like this is, just to be clear, 48%, 37%, 32%, 45%, 33% revenue growth. That's the average analyst. The analysts think this company is growing like crazy. This is a great company. However, no matter how great a company is, the price for that company could be too high. And that's what we're looking at right now. So I am using these analyst projections for insane revenue growth. I've plugged that into my spreadsheet. I'm using their most recent free cash flow margin. I'm assuming that for years 6 through 10, their growth slows down to 20% per year. And then I'm using a perpetual growth rate of 3%. Based on these assumptions, using the highest analyst projections, the fair share price for Palantir is $70 per share. So that is a massive downside currently because Palantir is trading at $180 per share. So based on the highest analyst projections, Palantir still has to overperform significantly for their current share price to be a good share price today. This is probably what Michael Burry is looking at. So when he invests in a company, he wants to see a huge margin of safety to where if the company performs as the analysts say, he wants to have a big cushion. So that way, if the company underperforms slightly, they're still undervalued. He still makes money. In this case, there is a negative margin of safety of 60%, even if Palantir is able to meet the expectations of the highest analysts. And so I'm going to make a few more tweaks here just to showcase how high their share price is. Instead of using a 20% free cash flow margin, I'm going to bump them up to a 100% free cash flow margin. Every bit of revenue, that means they have no expenses. If I use a 100% free cash flow margin, the average analyst puts them at fairly priced today, assuming a 100% free cash flow margin. That's the expectation of the average analyst. So let's bump them down to a more reasonable free cash flow margin. Nvidia's current free cash flow margin is about 45-50%. Let's use 50% as the long-term free cash flow margin. They're not even close to that yet, but we'll give them a big bump. Using 50%, the highest analyst expectation is they're fairly priced today. So if Palantir underperforms by just a little bit, let's say over the next 5 years, they only grow their revenue at 30% per year, and then in years 6 through 10 by 20%, which is still really strong growth. Like that's insane growth. If that's the case, then the share price is 62.27. That's a 65% downside. So in my opinion, what Michael Burry sees when he looks at Palantir is a company that is wildly overpriced. And as earnings reports come out, if they are not wildly exceeding expectations, then the share price will actually start to come down. And so in my opinion, that's what Michael Burry is looking at. He's looking at a company that is insanely overvalued, and the revenue growth that would be required to justify their share price is so unlikely that he is shorting this company before their earnings report. And what did we see out of Palantir? We saw that when they actually did release their earnings report, even though they outperformed expectations a little bit, their share price significantly dropped off. So in this case, I'm in agreement with Michael Burry that Palantir is insanely overvalued. However, it is difficult to say if he made any money on this put option or if he's still holding it for Palantir to drop further, which it looks like they are still incredibly overvalued. So he may be continuing to hold that put option. So Palantir, I don't think we have to look much further. The company is insanely overvalued. That's probably what Michael Burry is thinking. But when we move on to Nvidia, things get a little bit more complicated. If we start by going to their financials and looking at their ratios, the same thing that we did with Palantir, we can see that their price to free cash flow ratio is 63. So still very high, but not quite as high as Palantir. Their EV to EBITDA ratio is 46. Also much higher than the companies that Michael Burry is going long on. If just to remind ourselves, Pfizer had an EV to EBITDA of 7 and a price to free cash flow of 13. Still much, much lower than Nvidia. However, the reason Nvidia can get away with having such high ratios is their projected growth is also insane. So if we look at Pfizer's projected growth, we can see that the analysts are actually thinking on average that they are going to be losing revenue over the next 5 years. So yes, Pfizer is trading much cheaper than Nvidia and Palantir for a good reason. If I scroll down to Nvidia's revenue growth, according to the analysts, the average analyst consensus is 61% growth in 2026, 37 in 2027, and then it shows it slowing down after that, probably due to competition starting to catch up a little bit. So let's do the same analysis that we did with Palantir. Let's do that with Nvidia. I'm going to copy these projections according to the analysts, and I'm going to put it into my automated spreadsheet right here. And then we'll just put in Nvidia's ticker. For Nvidia, their past free cash flow margin over the previous 5 years was about 33%. However, more recently, they've upped their margin to about 45%. So I'm going to put 45 in there. The analyst projections are in. For my own projection, I'm using 24% per year. This is the average consensus for analysts, and then 15% growth for years 6 through 10. And based on these assumptions, Nvidia seems to be about at their fair share price today, according to the average analyst expectations. For Nvidia, it's less clear. I'm not seeing a short opportunity with Nvidia because they are in line. Now, there is no margin of safety, however. If Nvidia were to slightly underperform the analyst expectations, if their profitability was to drop back down to the average, then we can see it would be a huge hit on the share price. If I reduce their margin back down to 33, and if instead of hitting 24% per year on average, let's say they hit 15% growth every year on average, that would be really solid growth. However, the result would be a $91 share price today, which represents 50% of today's current stock price for Nvidia. So right here, we can see Nvidia is currently at 190. This is what I'm talking about when I say margin of safety. If a company slightly underperforms analyst expectations, we don't want to put ourselves as value investors in a position to lose 50% on a holding. And so I can see why Michael Burry wouldn't invest in this company, but it's not clear that there is a huge short opportunity. There must be something else that Michael Burry sees as a risk external to their current share price that could result in Nvidia not hitting their expectations in the near future. So what could that be? What are the big risks for Nvidia? Number one is their customer base. Nvidia's top 2 customers made up 40% of the chip makers' Q2 revenue. So Nvidia has high concentration in just a few customers. Now, they don't say who these customers are. They just say customer A made up 23% of total revenue, customer B made up 16% of total revenue, but there is some heavy speculation that it's going to be one of these big, large cloud providers, Microsoft, Amazon, Google, and Oracle. Could be one of these 4. However, Google, for one, is unveiling a new chip. So Google is starting to compete with Nvidia. So not only might other companies start purchasing their chips from Google, if Google was buying lots of chips from Nvidia, they may stop buying those chips. They might start just producing their own chips in-house, which would be a huge hit to Nvidia's revenue, considering they have such high concentration risk with their customers. So that is risk number 1. Risk number 2 is more of a philosophical risk. As a company gets larger and larger, it becomes more and more difficult to maintain a high growth rate. If I go to Nvidia's overview, they are worth $4.57 trillion. If they are going to continue growing their share price above the market rate, above 10% per year, then this company is going to end up at 10 trillion, 20 trillion market cap over time. There's only so big of a total addressable market. Eventually, as a sector of the economy is making lots of money, it's very profitable, competition is going to want to come in and take some of that market share. As Nvidia gets larger and larger, it will become more and more difficult for them to maintain their growth rate. And then finally, Risk number 3 is geopolitical risk. Currently, the Trump administration does not allow Nvidia to sell their flagship artificial intelligence chip to China. There is no guarantee that in the future, these restrictions could increase for other countries for lower levels of chips as well. A second geopolitical risk is that Nvidia relies on Taiwan to provide the vast majority of their silicon wafers, and there has been a long-standing threat that China will invade Taiwan. According to US intelligence, Xi Jinping, the president of China, told the Chinese military it needs to be ready to invade Taiwan by that year being 2027. So there's no guarantee that China is going to invade Taiwan anytime soon. However, it still poses as a risk, because if they were to invade Taiwan, Nvidia's revenue would suffer greatly.
What's up, y'all? We're back on November 13th, and Michael Burry also tweeted a little bit more information about his Nvidia put. So in his tweet, he says that 5 of Nvidia's alleged biggest customers are extending their depreciation schedule. So what does that mean? Let's say I spend $100 on an Nvidia server, and I can depreciate that server over 3 years. That means each year for 3 years, I am deducting $33. That's a third of the $100 purchase price, the $100 capital expenditure. I'm deducting $33 each year from my income, okay? Now, if I extend that depreciation schedule to say 6 years, well, now I'm only deducting 16 point whatever dollars from my earnings each year. So in the short term, it makes my earnings look like they're a little bit higher. And then eventually, whenever I have to keep losing money on those chips, and then I have to simultaneously spend more money to buy new chips to replace them, eventually that lower earnings catches up to me. So what the implication here is by Michael Burry is that these 5 big customers are inflating their earnings, making it appear that they're benefiting more from investing heavily in Nvidia chips and servers, whereas if they were not benefiting as much, maybe the market would conclude that it's not a good investment. These companies might go down in value. In turn, Nvidia would go down in value. That would be the possibility. I'm certainly not an expert in the correct depreciation schedule for Nvidia chips and servers. However, Michael Burry did include a table here where Meta, Google, Microsoft, they had their depreciation schedule at 3 years in 2020, and they have since doubled it in 2025. So were they wrong before? Are they wrong now? Maybe the situation has changed. I'm not sure. Michael Burry does say that more information will come out on November 25th. So I look forward to seeing the additional information that he's going to put out there on this subject. Just wanted to add one more risk factor that came out literally like the day after I filmed this video. So, okay. Back to your normal programming.
There are a number of risks on the horizon for Nvidia. Palantir is grossly overvalued. These appear to be the primary reasons why Michael Burry might short these companies. As a value investor, I focus on the intrinsic value of companies based on their discounted future free cash flow, because that is the only way that I can reliably create a buffer of safety. If you're interested in this style of value investing that Warren Buffett utilizes, that Michael Burry utilizes, then check out my most recent stream where we find companies that are undervalued in the market that have the strongest likelihood of making us money in the future, whether the market continues to rip as it has or if the market slows down. I hope to see you there.